Hi, good evening to everyone. Welcome to our monthly market outlook. If we look at the global scenario, the Fed balance sheet kept on increasing, and that resulted in P ratio of Nasdaq companies rising. Now, when there is a fear that Fed balance sheet may decline, the P ratio has already discounted that and started falling. Next slide, please. Next slide, please. When there is excessive monetary liquidity, undoubtedly inflation starts rising. And today, most parts of the world are facing above average inflation. This is one of the few period in my life where American inflation is higher than Indian inflation. Next slide, please. If we look at the commodity price cycle from the COVID bottom, it has started moving up quite significantly. It's almost highest compared to peak of 1993, 1933 post-Great Depression, or 1970 oil price shock. The only thing is that the steepness is much faster, whereas most other commodity prices were longer in nature. Let's hope and pray that commodity prices start stabilizing at current level. Next slide, please. The real worry for the market is when will central banks stop expanding their balance sheet? Now, on this, there is reasonable clarity. Fed is doing it in March 22. Bank of England has already done it. European Central Bank have not announced, but they should be doing it in probably a quarter or so. And the second question is, what will be the pace in winding down their balance sheet expansion? On this, there's not enough clarity, but this is the biggest question which will impact markets in the days to come. The COVID-19 scenario globally has started stabilizing. We have seen drop in active cases in US, UK, India, and other places. I think yesterday was the first day when our active cases dropped below 100,000 on a daily basis. Next slide, please. The markets have corrected on the expectations of rising interest rates and tightening of liquidity. S&P 500 has corrected minorly. Nasdaq 100 has corrected more than S&P 500. Small caps are in bear market with massive correction. Cryptos have seen crash, and hyper growth stock, the new age companies, are back into Great Depression. This is one of the tweet by a famous investor, Ben Carlson, that explains today's market. Next slide, please. Coming to Indian economy, the headlines have been positive for Jan 22. The GDP growth expectation of 8 to 8.5% in budget, 9% by IMF. Manufacturing PMI have fallen from highs but still in expansionary zone, and we started crossing exports of $30 billion consistently since February 21. COVID cases, as I mentioned, are now coming down, and active cases have fallen below 100,000 daily yesterday. The BRI index remains positive. It did fall because of the lockdown from 120 to 100, but we believe it should now turn around and start going back towards 110, 115. GST collection continues to remain above 1 lakh crore. The credit growth has started improving after bottoming out somewhere in mid 2020. As credit growth improves, economy should also continue to improve. The capex cycle led by energy, metals like steel and aluminium, utilities like power plants, telecom, industrials, etc., have slowly started improving. Overall, Indian economy remains in better shape. Now, coming to the budget, this budget is based on this philosophy. If you give a man a fish, you feed him for a day. If you teach a man to fish, you feed him for a lifetime. When COVID-19 hit us, we had no option but to raise subsidy. We raised subsidy from roughly about 250,000 crore in FY20 to 7 lakh crore in FY21. Now, in FY21, our total tax collection was 14 lakh crore, and of which 7 lakh crore we were spending on subsidy. This could not have lasted long, and hence we are transiting from fish to fishing so that people need not rely upon subsidy. Next slide, please. This budget can be also described as Janu's budget. One side, the debt markets have taken this budget negatively, and equity markets have taken this budget positively. It was told that Janus has two faces, one of war, other of peace, and this budget certainly created downfall in debt market and kind of rise to stability in equity market. Why did debt and equity market treated this budget differently? Well, next slide should explain you. This budget is very, very conservative on divestment. Look at how divestment numbers have come down from 1,75,000 crore to 65,000 crore. The small savings collection has come down from 5,91,000 crore to 4,25,000 crore. That's a drop of 1,66,000 crore. The net cash drawdown has come down from 1,74,000 crore to just about 8,000 crore. RBI dividend has declined by more than 27,000 crore from 1,01,000 crore to 74,000 crore. And the biggest disappointment is on the tax revenue. In the first 9 months, our tax collection is 14.74 trillion. In the previous Jan, Feb, March 21, we had raised $4.6 trillion by way of tax revenue. The first 9-month collection is up by 53% over FY21 data. Now imagine if we collect same money which we have collected in previous 3 months without not considering this 53% growth, our collection should be roughly about 19.3 trillion rupee. Against that, we are assuming only 17.65 trillion receipt. We believe this number in FY22 will be 20 trillion plus. And this number, 19.35, will be 23% plus, 23 trillion plus. You could see that there is so much of underestimation of revenue. And that is where markets are unable to figure out what will happen with the actual borrowing program. The debt market feels that actual borrowing program will be high in spite of this revenue increases. Equity market feels that you will be spending this money on investments and growth will be better. If I have to rewrite this slide in just one equation, you know that Economic surveys estimated next year's GDP growth at 8 to 8.5. And you also know that RBI has estimated inflation as 5 to 5.5. Now, real GDP growth plus inflation is equal to nominal GDP growth. The nominal GDP growth estimated by RBI is 11.1% this year. If we add 8 plus 5, it is 13. If we add 8.5 plus 5.5, it is 14. It is certainly not 11.1. This is the biggest disappointment for the market. Let's go to the next slide. This budget has focused on teaching fishing to people. They have focused on agriculture, manufacturing, services, and also focused on environmental. For agriculture, policies for chemical-free agriculture, organic farming, and encouraging oil seeds for import substitution is being undertaken. River linking project will reduce flooding and improve irrigation. On manufacturing, 68% of defense outlay is reserved for local manufacturers. There will be JV/SPP between defense research and private companies. PLI for solar panel has been enhanced to 19,500 crore. Gati Shakti Yojana is working to reduce logistics cost. Emergency line credit guarantee scheme is extended till March 23 to support small and medium enterprises. Allocation to housing and water will also support industrial recovery. On services side, digital banking is launched through 75 new digital banks. Optical fiber connectivity through BharatNet will bring high-speed internet to villages, and post offices will come under core banking solution so that we can move rural savings from physical assets like land and gold to financial assets. On the environmental side, we are focused on fuel blending policy for ethanol and petrol, diesel and ethanol and petrol. We are encouraging private forestry, agroforestry, which has resulted into increase in green coverage. Biomass pellets will be used in thermal power production. Battery swap and interoperability standards will be created to support electric mobility. And sovereign green bonds will be launched to support environmental control, environmental support. All these things have definitely passed a message to FPIs that government is focused on growth, but it will come with green as well as governance. This, we believe, will be music to the FPIs, and right now they might be selling, but eventually they will become buyer. Next slide, please. If you look at equity markets, the small and mid caps have continued to outperform large caps. Small caps have delivered almost double the return of large caps. And in this calendar year, CY22, just first 31 days, energy, bank, auto, private banks have done better. And last year's better performing sector like IT hasn't done that well. Next slide, please. The FPI selling can be partly ascribed by this. We were generally between 8 to 8.5% weight in MSCI, but in last 1.5 years, we have increased to almost as high as 12.4%. We have done well, others haven't done well. And today when FPIs have to book profit, obviously they will book profit from country like India where they have the profit. The impact of FPI selling this period is very, very calibrated. In March and April, they sold 69,000 crore worth of equity and pulled the market down about 12%, and it was down 40% from the top. October to Jan, they have sold almost similar amount at 71,000 crore, and market had barely even noticed it. From top to bottom, the fall, excluding today's fall, is just about 5%. The selling is almost similar, but the impact is totally different. And that is essentially happening because in this period, FPI selling is calibrated, gradual, and with limits, price limits. In this period, there was no price limit. They were just dumping the stock and running away. Next slide, please. Valuation-wise, our view remains market is neutral weight, and even momentum right now is neutral, neither favoring bulls nor favoring bears. Market cap to GDP ratio at 116% is above historical average of 76%, but compared to global average of 144%, is at a reasonable discount, at a reasonable spread. P ratio, historical average 18 times, currently 20 times. Price to book historical 2.7, currently 3.2. This marginal premium can be explained by better quality of earnings and lower interest rates. If we look at December quarterly results, we are on our way to achieve this profit growth journey. 542 rupees was FY21 earning. We should be ending this number for FY22 anywhere between 725 to 750. And FY23, we are somewhere on course to achieve 850 to 875 earning per share. If we assume this numbers, it really provides protection on the downside, as we are trading now about 20 times FY23. The December quarterly results which have come, 12 companies out of 25 above expectation, 8 in line with expectation, and only 5 are below expectations. The PET growth is running at 17%, higher than estimate of about 16% growth. And as I mentioned, the earning per share in FY23 is somewhere around 850 to 875. Over here, it is 885. That is based on this upgrades. And next year, we are looking at a 1,000 rupee earning per share in FY24. Our view remains marginal overweight large cap, marginal underweight mid cap, equal weight small cap, and equal weight overall equities. There are concerns on market. The first and the most important concern is Fed. Fed today is like this firefighter. Their house is on fire with inflation in US running at 7%, which is higher than Indian inflation of 5.6%. But instead of fighting fire through rate hikes and liquidity tightening, Fed is watching, hoping that fire will stop on its own. Their current interest rate is 0%. In India, interest rate is 4%. You can imagine how Fed will react to this. Will they raise interest rates aggressively to support their credibility? Will they raise by 50 basis points in March? Will they announce instead of 3 to 4 rate hikes, 6 rate hikes? We don't know what Fed will do, but certainly today, Fed is as helpless as this fireman, where fire is raging in terms of inflation at 7%, and Fed is yet to begin its action. Geopolitically, India-China border is hot with soldiers standing eye to eye. Taiwan regularly sends fighter planes to Taiwan. Russia, Ukraine, and NATO is doing a shadow boxing. And Houthi rebels have been firing missiles to Saudi and Middle Eastern countries like Abu Dhabi. Any of this event escalating will have impact on our market. The oil prices have moved from somewhere around 60, 70 to $90 a barrel. They are likely to go into 3-digit and cross $100 a barrel. To some extent, Indian economy is able to withstand this shock because our IT exports at $173 billion is likely to be higher than our oil import bill. All eyes on February 10th now, when RBI is going to announce its credit policy. If they raise interest rates because inflation is 5.6 and decide to tighten liquidity, then Indian markets valuation at about 20 times FY23 will come under pressure. So we have to watch on February 10th what RBI announces. We have launched our Kotak Manufacture in India Fund on 1st of February. There is encouraging response from distributors. Banks are also selling this fund. We hope and expect all of you to participate in this fund. Let me give you one slide story why you should consider Make in India Manufacturing Fund. In mobile handsets, in FY14, we were 12th largest manufacturer in the world. Our import was $8 billion and our total production was 27,000 crore. Government introduced phased manufacturing program, PLI scheme, 100% automatic FTI, single window clearance, tax cuts as incentive for global companies to come and set up their manufacturing plants in India, electronic clusters for plug-and-play starting of factory, and import duty protection on finished goods so that people manufacture in India. Fast forward FY21, our production value of mobile phone is 2,20,000 crore. It is up 12 times from FY15, 19,000 crore rupees. We have now become from 12th to second largest manufacturer in the world, overtaking South Korea and Vietnam. From $8 billion imports, we are now exporting $5 billion worth of mobile phones. This journey of 12th to second largest manufacturer, 8 billion imports to $5 billion exports, and from 19,000 crore production value to 2,20,000 crore production value demonstrates that Indian manufacturing companies are likely to do well in the days to come. And investing in Make in India, Manufacture in India theme will be appropriate. Across all our portfolios, we remain bullish manufacturing as global companies move out of China to buy from India. Government of India's production-linked incentive scheme supports manufacturing. Companies sitting on cash starts investing. Housing sector, which we have talked about many a times, will take off and support India's manufacturing. And many investments will be done from an environmental point of view, opening local and global market for Indian manufacturers. In last 10 years, manufacturing index has done well. Last 5 years, there has been not so good performance. And which is why now we believe that on the basis of this underperformance, there is a good opportunity for Manufacture in India Fund. We will recommend your investors to do SIP in this thematic fund. It is higher risk, higher return fund, but one should consider investing in this, considering what happened to mobile handsets manufacturing sector. Next slide, please. In terms of equity funds, to look at current level, I mean, we want to reassure you that across majority of our funds, we continue to outperform benchmark indices and generate positive alpha. This is also visible in our SIP performance across almost all our equity products, across all the time periods of 3-year, 5-year, 7-year. We are delivering double-digit return with positive alpha. I will recommend you to keep a watch on Kotak Blue Chip Fund, which is a large cap fund, and Kotak Infrastructure and Economic Reforms Fund as a play on capex. One can also look at funds like Kotak Multi-Asset Allocator Fund of Fund or Kotak Tech Saver, which gives you exposure across different categories of underlying funds. Kotak Tech Saver is also coming with tax advantages. I had promised last time that I will talk about Kotak Flexi Cap Funds underperformance. This is the exercise we did it on 31st of December. So all this data is related to 31st of December. If you see across time periods, Kotak Standard Flexi Cap Fund had done well. However, in last 2 years, the performance of the fund is concerning. It has underperformed benchmark indices in most of the periods if we evaluate based on last 2 years' performance. The way we manage Standard Flexi Cap Fund, we are focused on growth at reasonable prices. So we don't buy stock at any price. We are doing bottom-up research to pick up our stocks. Because this fund is the largest equity fund, we remain biased towards large cap. This fund is generally 75% large cap and 25% small and mid cap. Our stock selection is vigorous based on businesses which generate more return on equity than cost of capital over a business cycle. The management is someone whom we can rely upon and who respects minority shareholders. We buy companies at a price which is reasonable, not excessive. We also evaluate all these companies on ESG standards. And our USP in this fund is to invest in companies which are all very, very efficient allocation of capital. In one line, if I have to say, Standard, our Flexi Cap Fund is a portfolio of long-term compounders. They may not work well in 1 or 2 innings, but over the life cycle, they will score well. Now, let me take you why, what has worked for Flexi Cap and what hasn't worked. These are the positions where we were overweight compared to benchmark index, and it has delivered alpha over benchmark index. We picked up stocks like SRF, Bharat Electronics, Jubilant Foodworks, ICICI Bank, Ultratech Cement, and Balkrishna Industries. They all delivered outperformance to us because we were overweight by a significant margin over last 3 years on these stocks. So let me assure you that our ability to pick up stock has not been dented. We have picked many winners in Flexi Cap. These are the stocks where we were not invested, and by not investing, we have generated positive alpha. You all know ITC stock is where it was 5 years back. HDFC in last 1 year has not been able to deliver great return. Maruti Suzuki, except Jan, was struggling. Yes Bank and Coal India, we never invested because of ESG concern. And all this underweight calls also helped us outperform benchmark index by generating positive alpha. These are some of the stocks where our call didn't work out. We had invested in Ratnakar Bank. Unfortunately, the bank got entangled in management transition. We booked our losses and exited completely. In Bajaj Finance, we sold it. We had invested, made a lot of money, sold it, saying that this has become expensive, but the stock continued to do well, and we corrected our mistake by getting invested. In Petronet LNG, since the time we invest, this stock has given us a negative return of 1.2% in alpha. Why are we still holding these positions and not booking our loss? Because in last 5 years, the profit of these companies have compounded at 26% per annum. In essence, they have more than doubled from 5 years before level. And the P ratio of the stock is now at 11 times. The PG ratio is more than 2, as company is growing much faster than the P ratio. We believe Petronet LNG someday will reflect its fundamentals, and hence we are holding on. Same thing was with Axis Bank. We had picked up this stock and we're holding on despite it generating negative alpha. I'm glad to report that in the month of January 22, this underperformance has been well covered. We also didn't invest in HCL Tech because we were invested into Infosys and Tata Consultancy Services. Now, this also resulted into underperformance. As you can see, there are stocks like Ratnakar Bank, where we invested, didn't work out, and we cut our losses. There are stocks like Bajaj Finance, where we sold out early, realized our mistake, got invested again. There are stocks like Petronet LNG, Axis Bank, where we build our position. And because fundamentally they were solid companies and they were valued cheap, we continued to remain invested. On 31st of December, Axis Bank had negative alpha. On 31st of Jan, it became positive. There were stocks where again our call didn't work and we cut our positions. For example, GAIL, it didn't work, we cut our positions. Hero MotoCorp, again, it has not worked well for us since our investment, but we are hopeful that this stock will deliver return as demand recovers for two-wheelers. Stocks like Asian Paints, we have avoided, even though they have delivered great return because they are trading at 100 P. In Wipro, we missed out management change. And now we believe it's better to own TCS or Infosys compared to Wipro. On Reliance Industries Limited, we could not invest more than 10% of our fund in Reliance Industries Limited. That is under regulation. There was no choice. And that also resulted into some underperformance. Same thing in Tech Mahindra, Container Corporation, L&T, Titan, Avenue Supermart. Titan gave a very good result, go back, but it is available at 136 P. DMart gave a great results, great past performance, but it's available at 175 P. We are avoiding this kind of expensive stocks and taking underperformance and investing in stocks like Petronet LNG, which is available at 11 times, or Axis Bank, which was available at 2 times price to book. Obviously, we also missed out investing in Adani Group of stocks. They were all excellent businesses and they have done extremely well on stock market. But at current valuations of 260 times, 166 times, 343 times, we believe the risk-reward ratio is unfavorable. our entire negative alpha or underperformance to benchmark index is attributable to expense ratio and the cash which we had to keep in the fund for meeting daily redemptions. Other than that, some stocks worked, some didn't. We took corrective action, rebuilt the portfolio, and are hopeful that this portfolio will start delivering outperformance over benchmark index. If I have to give you one slide summary, there were stocks where we were overweight and generated positive alpha. By and large, we have allowed our profits to run. There were stocks we were underweight and generated positive alpha. We will keep them on our radar and invest as and when appropriate. There were stocks where we were overweight, but it didn't perform. We booked our losses and exited. Gail Ratnakar Bank will fill over there. There were stocks where we are overweight. It has not worked now, but we remain invested for future. Petronet LNG, Axis Bank, Larsen and Toubro, Container Corporation fills in that category. We believe they will all deliver good return going forward. There are stocks where we are not invested. They have given us negative alpha, but we are not investing into them because of expensive valuation, which is Asian Paints, Titan, DMart, and so on and so forth. There are stocks where we are underweight and have given negative alpha, but we have taken better peers, and over a longer period of time, it works out. And then there are stocks where we exited early, realized our mistakes, and reinvested, like Bajaj Finance and Reliance Industries. The whole purpose of this exercise is to show you that we are working hard to regain our performance and outperform benchmark indices. We haven't lost our touch in picking up stocks. Sometimes you take little time to get your calls working. On the crypto, there has been a bloodbath with rising US interest rates, and a lot of cryptos have fallen between 50% to almost 84%. This budget, government allowed Reserve Bank of India to launch digital currency. It will be known as central bank digital currency. It is completely different from crypto. Crypto is a digital asset, virtual asset. Central bank digital currency is more like wallet. Rupee will move from being physical in your purse to digital on your mobile, and you will be able to use it just like payment wallet. The difference between payment wallet and central bank digital currency is that when you are using wallet, you are taking credit risk on payment company. On this, you are taking risk on RBI for digital wallet for central bank digital currency. Should we invest in gold? If you look at gold to S&P 500 ratio, it is almost at lifetime low, which means S&P 500 is expensive and gold has become cheaper. So globally, there should be some allocation to gold based on this ratio. We have also seen some flows coming into gold ETF. It is one of the highest in last couple of years. So money have started moving to gold, which should be positive for gold in the days to come. Coming to the fixed income market, the debt market reaction to the fixed income market was quite negative. They were spooked by this borrowing program of 11.18 trillion over 7.75 trillion. It's a jump of almost 343,000 crore. Sorry, 3,43,000 crore. This is what has spooked the market. And one of the reasons could be this. because small savings collection, they have underestimated compared to previous year by 1,66,000 crore. Now, RBI's intervention becomes critical. Will we see reduction in borrowing program like last year, where they had said we will borrow 9,25,000 crore, but actually borrowed 7,75,000 crore? It was less by 1,50,000 crore, or they'll borrow to the full extent possible. We'll have to see how this shapes up. Liquidity continues to remain fairly positive in banking system. Inflation, while being sticky at between 5 to 6%, it has remained well within RBI's comfort zone of 6%, bearing few periods in 2019-2020. Since almost middle of 2020, inflation has remained within RBI's comfort zone. In terms of real interest rates, we are at one of the highest spread vis-a-vis US in our history. This is the real interest rate spread compared to taper tantrum in 2013, when the spread was roughly about 400 basis point. We are today at roughly around 600 basis point, which should be supportive for our market. The spread on current yield curve is higher than historical averages. Normally, 10-year minus CBLO averages 165 basis point. Currently, we are at 350 basis point. 10-year minus 1 year average is about 76 basis point. Today, we are at 245 basis point. 10-year Indian gilt over 10-year US yield is roughly 420 basis point. We are already at 510 basis point. The same trend is visible in 30-year spread, 30-year gilt. So we believe lot of rate action by RBI is already discounted into the market. On the debt side, a lot of eyes will be on 10th February credit policy. We'll be able to give a far better view post 10th of February. At this point of time, if you are investing in debt, keep a watch on floating rate bonds. Floating rate fund will be relatively immune against rising interest rates, as their coupon gets reset with every reset date with increased benchmark. At this point of time, we believe short end of the curve is safe from investment. One can look to invest in corporate bond fund, short-term bond fund, gilt fund, or banking and PSU debt fund, apart from floating rate fund. Dynamic bond fund also has done well. Last 1 year, dynamic bond fund return is almost low single digit. If this year interest rate starts stabilizing after this spurt, dynamic bond fund should be able to deliver better return than previous year. It will be worthwhile for debt investors who are worried with mid-single digit return in debt funds to consider hybrid fund. Kotak debt hybrid scheme is consistently generating positive alpha and giving double-digit returns. Same way in Kotak equity savings fund, we have generated positive alpha and delivered most of the time double-digit return. And Kotak equity hybrid scheme also consistently positive alpha with double-digit return. So clearly, people will be better off In hybrid schemes, in debt hybrid fund, equity allocation is 10 to 25%. Equity savings fund, equity allocation is between 25 to 50%. And equity hybrid fund has equity allocation between 65 to 80%. So depending upon the need, one can select either of the fund, and it should deliver better return than fixed income, albeit at higher volatility. One way is to do allocation depending upon the valuation of the market. In a cheap market like March 20, one can invest in large cap equity fund like blue chip. In a fair value market like today, one can invest in balanced fund, which gives you 65 to 80% equity exposure. And in an expensive market like Jan 20, one can look to invest in Kotak debt hybrid fund, which is 10 to 25% equity. Now, in Jan 20, we didn't think market was expensive, but that's because we mispriced COVID-19 risk or FPI selling. But through this kind of mechanism, also one can generate return for investors. And this is exactly what we try to do in Kotak Multi-Asset Allocator Fund. This fund also, as I explained earlier, has double-digit return for investors across a long period. With this, I will end my presentation.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.